Hello everyone. Today I'll be presenting portfolio components for financial assets for a future-based portfolio, where we will explore the financial assets that we plan to implement in our portfolio. In this chapter, we're going to discuss 4 key financial assets: stocks, bonds, commodities, cryptocurrencies. Each of these assets offer a unique benefits and risks, and our goal is to create a diversified portfolio that balances growth potential and risk management. Onto stocks. So stocks represent equity ownership in companies and are fundamental for achieving long-term growth. Historically, the S&P 500 index has averaged an annual return of about 10%. Which highlights a strong growth potential. Strong growth potential of stocks. Stocks also offer diversification opportunities by investing across different sectors and geographic. Stocks also offer diversification opportunities by investing across different sectors. This helps mitigate specific company or country risks. Additionally, stocks provide dividend income, which can offer a regular income stream which potentially benefits capital appreciation. Investing in emerging markets can offer higher growth potential, although this comes with a higher volatility and risk. Onto bonds. So bonds are debt securities that pay periodic interest and return principal at maturity. They are typically less volatile than stocks and can serve as a hedge against equity market downturns. Government bonds, such as the US Treasuries, are considered low-risk investments, while we consider corporate bonds offer high yields to compensate for the increased risk. Bonds are essential for providing a steady income stream and reducing overall portfolio volatility, which is crucial to conserve investors or those approaching retirement. During 2008, the financial crisis, the US Treasury investors or those approaching retirement. During 2008, the financial crisis, the US Treasuries performed well, underscoring their role as a safe haven asset. Additionally, municipal bonds, they offer tax advantages for investors and seeking tax-efficient income. Onto commodities. So these include physical assets like gold, oil, and agricultural products. Commodities provide diversification benefits due to their correlation and traditional financial assets. For example, gold is often viewed as a safe haven asset, preserving value during times of economic uncertainty and inflation. This is because it is a limited asset, and it won't run it, and there's not much of it. So investing in commodities can protect against inflation and currency fluctuations. Commodities can be accessed through future contracts. Commodities focus on mutual funds or exchange traded funds, ETFs. Industrial metals such as copper and aluminium are essential in various industries, and their demand rises with economic growth, providing additional diversification. Onto cryptocurrencies. So such as Bitcoin and Ethereum, they represent a new and highly volatile asset class. They offer high returns, but come with significant risk due to their price. So cryptos offer diversification benefits because their price movements are often uncorrelated with traditional asset classes. However, Bitcoin and annualized volatility has been significantly higher than that of stocks and bonds, which underscores the need for careful risk management. Additionally, decentralized finance platforms offer new opportunities for earning yields through staking and lending. So, to conclude, implementing a diversified range of financial assets, including stocks and bonds, and commodities and cryptocurrencies, can help achieve long-term growth stability. Each asset class offers a unique benefits and risks, emphasizing the importance for diversification and risk management.
Okay, hello, my name is Newton Marcus, and my part to discuss about our group assignment is the risks associated with the financial assets that we choose to invest in and to put in our portfolio. So the first financial asset that we want to implement in our portfolio is is stocks. But the risks of stocks are business, so change in business or maybe change in leadership that can lead to financial losses. Factors like downside are also risk. So investing into a company that is in a decline and doesn't show any future uh, gains. Economics is also a risk because the recession, currency fluctuations can have a effect on how the company in that specific economy is going to grow or is going to descale. Inflation is also a risk. Inflation is a risk because the purchase power of your money becomes less, and that also has effect on a business. So they can buy less resources to make the business grow. Or political issues. Or political issues can also be a risk for stocks because if a certain political statement is made about uh, about energy that is not green, then that can have a impact on like on companies that run on non-green energy, and that can be a determining factor for a company that is not doing good. And being too conservative when investing in any stock. When you are too conservative, you don't take any action. So when a opportunity presents itself, you won't take take the opportunity because you are too scared to act on that. Ways to hedge against these risks are to diversify, so have more than only stocks in your portfolio, and more than one kind of stocks. So maybe buy stocks from the health uh, sector and stocks of the construction sector. Focus on long term research for quality stocks and not penny stocks, and do a regular rebalance and regular review of your portfolio. The second financial asset that we want to implement in our portfolio are bonds. The risk of bonds are interest rates. When interest rates go up, the buying of bonds goes down. reinvestment risk. When you have a reinvestment risk, a lot of bonds can be cancelled at once, which is not good. Because that means that uh, people don't want to have bonds anymore, and they are selling their bonds. So people are not lending money, and if people are not lending money, then companies can't can't and then the companies will not have money to invest into their own or to grow. A, a credit risk. This is a risk because bonds are like lending contracts. So if somebody who is lending, so if somebody is lending money, they could be a risk of credit when they can't when they can't pay back the bond that they lend the money for. Then they're a risk for the credit of the company that issued the bond. The inflation is is also a risk, just like stocks. So the purchasing power goes down, and then people are buying less bonds, or the bonds they could buy before they can buy anymore right now. Rating downgrades. So rating downgrades is when a company has a low credit rating, which is going to result in banks and other companies who issue money and who do the lending and who provide money to be lended. A company with a low credit rate, they will have higher fees when they lend money, because that company shows that they are not a a safe a safe entity to go in business with in the lending of money. They are too risky, because the low credit rating shows that they can't pay back the loan as fast as is required. And then a liquidity risk. So with bonds, it is very important to have enough money going around in your company to pay for the debts and for the expenses that you have within your company. And if a company doesn't have it, then it's a risk. And how to hedge against those risks is holding a bond. Holding a bond for a period of time can reduce the interest rate risk. Have more maturities over time will reduce reinvestment risk. Investing in short-term bonds can mitigate inflation risk. Monitor monitor credit ratings or bonds can mitigate a credit risk, and maintaining a healthy debt income ratio is crucial for financial stability. The third financial investment that we want to implement in our portfolio are commodities. So the risk of commodities are the automobile manufacturers. So commodities are rice, grain, gold, silver, oil, everything that is actually tangible, so that you can touch. But the problem is are those products are made somewhere in the world, and they have to be transported to a store or a warehouse or something else. But for that, there are cars needed, planes and boats. But when those planes, boats, and cars don't work anymore, then the commodity can't be traded to another country or to another store, and that's a risk. And the other risk are the producers themselves, because the commodities are a physical asset. So when the producers are so when the producers are having issues with the production, then that immediately results in a higher price in the commodities, and that's not good. And how to hedge against those risks is to buy futures and option contracts of those same commodities. So you have now a contract of the same commodities that you bought, but then a, a portfolio. And in the times of a depression or a recession, you will see that the commodity prices goes up when the stock prices go or goes down. Because in desperate times, everybody goes back to using commodities instead of stocks and all those things. The fourth and final financial asset that we wanted to implement in our portfolio are cryptocurrencies. The risk of crypto are they are very volatile because their price is heavily based on 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 the sentiment of what people think. Taxes are also a risk the cryptocurrency because the cryptocurrencies are are not regulated. So there is no tax system uh, associated uh, uh, with them. And you see when there is no regulation, things tend to get out of hand. The other risk is user side risk. This is a risk of because when we're choosing a wallet to use, it's very important because the key that you get for your wallet is the key is personal. But some blockchains, the key can be kept on the chain itself, and in other cases, the person has to keep the key safe for himself. So that difference can be a vulnerability in in the crypto space. A Technica. Uh, so the crypto space is very new, but the systems are very complex. So because it is new and not enough, and there is not, and there hasn't been much time for people to really dive dive deep into those those mechanics. Things can get uh, very complicated that result in issues later. Another risk are scammers. The crypto space is very scam heavy because hackers can hack your wallet or can hack accounts and they can take the coins away. And this is a very big problem, which why this is a big problem, and this is also why a lot of governments don't see crypto as a safe future for payment right now. Maybe in the future, but right now they don't see it as a safe way to make payments. And the protocol server side. So, like I said before, there are a lot of there are lot of technical programs, but they are very complicated. So it's hard for a lot of people to understand, and those create risk because if you don't know what you're investing in and you don't understand it, then you can lose a lot of money. And the last risk is the centralization and the government's risk because the cryptocurrencies are not regulated um and are not supported heavily by the government, and they have a lot of issues. Governments don't want to use them in our day-to-day life because they are very scam heavy. They are decentralized and they are very private, which the government doesn't want. The government wants to keep an eye on everybody and what they spend, and this doesn't help their narrative. And how to hedge against these risks is to buy future contracts, to buy option contracts, diversify, and to do short selling. If we look at the allocation of our portfolio, uh, how we how we want to how we want to allocate our portfolio is from the least risky to the most risky asset. So stocks and bonds are 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 the first two, and between stocks and bonds there will be 60%. Uh, there will be 60% divided between the two of them. So stocks 30% and bonds 30%. If you dive deep, so if you dive deep, you will actually see that bonds are actually more secure than stocks because bonds are a guaranteed money income because it's a lending system. So when you lend money, you will get the money back. And stocks are associated with companies, and companies can go bankrupt. But that difference is so small that I put them on the same level. So 30% for stocks and 30% for bonds. Then we have the commodities, which we put 25% to, and the crypto we put 15% to, because this one is the most risky. Thank you for listening. This was my part, and now we go over to Max.
Future proofing of the portfolio in question from the thesis. Let's begin. Getting relatively good returns while also being resistant in multiple financial environments. That's the definition of future proofing that is used in the thesis and the whole mindset that was used in future proofing. What is in financial environments? Well, I've broken the financial environments down into three categories: a recession, dwindling trust, and major change. Going into a recession, the economic activity slows down. People don't want to spend their money anymore because they don't have the money to spend on those things, so luxury products are not necessary anymore. Not that much. A keyword in this environment is defensive. And what do I mean with defensive? We'll get to that later. Dwindling trust. Dwindling trust could be seen during COVID-19. With dwindling trust, people tend to lose trust in their government and thus lose trust in their currency. Because the currency isn't tied to the gold standard anymore, what is it worth? Will it be worth something? And people just freak out. And lastly, major change. What is major change in this scenario? Well, tech. Look at the dot-com bubble, look at AI, look at what that did to the whole market. Not only the stock market, but worldwide. Fintech is a very good example of major change. What's it gonna do? Uh, where are we heading? And you need to keep that in mind. And geopolitical. Think about war. Think about ties between countries that aren't going too well, or maybe very well, and you'll get better deals with that country. So let's look at the options. You have commodities, stocks, bonds, and cryptocurrencies. That's the things we focused on this thesis. And I've put a one word on every one of those um, types of investments. Finite to commodities. Think about gold, think about oil, think about consumables like grain. They are finite, like gold is really finite on Earth, but the grain is not finite. You can plant more, get more, but people need it. It's consumable, and thus it doesn't really react. It does really react to inflation. When your buying power goes down, commodities tend to go up. With stocks, they're really dependent on all the factors. Are you in a recession and people can buy that much? They won't be buying on the stock market, but they will be. They won't buy that many luxury products like microchips maybe, or with Amazon, they won't use their services as much as they would without the recession. With bonds, they're defensive. So, like I said, in a recession, people will tend to buy bonds because they offer a fixed return. And this, when you go into the contract, and this could change for the better or the worse for you later on, but it's fixed in the contract. And cryptocurrencies, that's more of the major change. Cryptocurrencies, fintech, they go hand in hand, and they're very versatile. You can use them on very different uh, things, and you can use them on very different investments. So in conclusion, all of these should be in a future-proof portfolio with the right percentages. You want to be steady going with the commodities. You want to be steady going with the bonds, so you have protection against recession or maybe inflation. With stocks and cryptocurrencies, you can up that risk and maybe get some more returns if that goes well. And if it doesn't go well, well, the bonds and commodities will keep you down and limit your losses. And that was it about future proofing.